Good afternoon, traders and investors. Will back here with another one, coming to with a Wednesday market recap. Hope all of you had a very good day today. And in today's markets, guys, well, the markets had a tiny little bit of a tumble prior to Nvidia earnings. They had a case of the earnings jitters, and with well-due reason, guys, because after the close, Nvidia right now is actually down about 6%. However, it is not because they reported bad earnings. Their earnings were actually fantastic. This is just another sign, guys, that the markets are getting very timid in relation to tech growth numbers, especially for the foreseeable futures, and putting more emphasis, guys, on the consumer discretionary spending recession slowdown, which may just lead to layoffs and potentially dwindling in corporate profits. The market is extremely timid right now. Even though the SPY is at relative all-time highs, guys, a lot of our big tech names are significantly off their own all-time highs, and we've been noticing kind of this rotation away from your growth names and possible tech names into more of a value and defensive nature in the markets. That has been occurring now for about the past month and a half worth of trading. The high-flying stocks are now pretty much getting picked off one by one. We had another one of those come in with earnings this morning, Abercrombie & Fitch, known as one of the high flyers since 2023, tumbling down about 17%. Their earnings were actually quite good, but this is actually the first time that they finally acknowledged that there is decently a consumer slowdown and a possible uncertain macro landscape ahead of the company. And as a result, the company was unfortunately down 17%, but their numbers and even their guidance was quite good. But that little hint by management about a slowing economy is what made the stock tumble. This stock now joins a list of a lot of other companies, a lot of other high-flying names in consumer discretionary that are down significantly from just a few months ago. CELH, one of the big winners over the last 2 years, they as well are now down 61% off of those consumer slowdown data points that we've been having, right? Another one, Elf Beauty, tremendous company, reported fantastic earnings. They are also down 30%, right? These high-flying names are getting picked off one by one, despite reporting very good numbers and having very decent guidance. Just the premise of the warning issued by these companies is enough to bring them down significantly from their all-time highs. And now, unfortunately, Nvidia is kind of suffering that same fate, not because it's a consumer discretionary facing stock, but this is the other portion of the trades that are getting wound down, right? The tech growth name trades. Nvidia down about 7%. We're going to cover their earnings, but there's a host of other ones, right? SMCI. Now, today, of course, they had a minus 20% day because they delayed the filing of their annual report. Usually, it's not supposed to affect a company that much. Prior to today, though, that company was down 51%. Another one of your semiconductor names that was a high flyer, ARM down 34%. Micron, another one of the high-flying ones leading into that June session, they are down 40%. You guys can see the trend is continuing for a lot of these companies, guys, and it is not looking the best for tech right now or consumer discretionary, which is why personally I have been positioning more and more into value as we go into these growth concerns and consumer discretionary concerns, guys. I am just being very, very cautious about which stocks I am choosing to play in light of the new data that has been coming out, right? So, fair little warning sign in terms of positioning for these markets. Now, in today's video, guys, we are going to cover a few things together. I have 3 earnings reports prepared for you guys, and those are going to be the following: Nvidia, CrowdStrike, and Salesforce, arguably the 3 biggest ones today. Chewy had fantastic earnings. Abercrombie & Fitch had very good earnings as well, but as I said, that little bit of a warning for economic uncertainty is what really made them unravel. Tomorrow, we do have some other decent earnings, guys. Lululemon and Ulta Beauty are going to be the biggest ones of the day, and we may even cover Autodesk's earnings as well. Thereafter, guys, we're going to go through our major technical analysis rundown of our major stock market indexes, see how everything is shaping up, and where is the money going to, because it's definitely not staying in the QQQs, right? And then we're going to take a look at our major tech names as well and derive potential levels for entry opportunities in the foreseeable future. So without further ado, guys, a lot to cover today. Let's jump right into it. SPY down about 0.7%, QQQ down about 1.13%. In the after hours, however, the damage continues because of the sheer weight of Nvidia's earnings, the decline, right? sheer weight that they have in the index has brought down the rest of the market. So SPY down an additional 0.68, QQQ down an additional 1.18%. And even in your big tech names, if we go have a look, right, AMD in the extended hours, 3.75 downside, Amazon down another 0.5%, Google 0.5%, Meta 1%, Microsoft 0.5%, Netflix 0.5%, Nvidia's the 7, Tesla 1.5%, and even Palantir down a whopping 2%. So you guys can see the effect that Nvidia's earnings had on the rest of the market. Remains to be seen, of course, how it actually manifests into tomorrow's live action trading. Taking a look at the heat map here, guys, and you will see the rotation that I've been talking about now for a considerable amount of time. The rotation into defensives and value. All of our big tech names were down today. Semiconductors really had a little bit of a bath. It was worse at the midpoint of the day. They did recover roughly half of the losses, but there was a certain point, guys, today where Nvidia was down 4% prior to their earnings. All of your software as a service companies as well taking a little bit of a tumble. So the rotation into financials, healthcare, and consumer defensives, guys, does simply continue. Industrials also getting a decent amount of love today. On a one-day relative performance, you can see that even better, only financials and healthcare able to keep it up ever so slightly. Healthcare was noted as a slight little decline, but they are at least the least worst sectors of the day. Where the damage was mostly done, once again, technology and consumer cyclical. I would be very cautious where you are buying these two sectors here, guys. They, in my opinion, will continue to potentially have pain as we move through this market uncertainty, right? The markets are extremely timid right now. You have probably noticed this as well. It is not the same market conditions as it was roughly 2 months ago. There is a lot more timidness right now, a lot more de-risking going on in the markets as a whole, as we're dealing with a lot of headwinds right now. We have the consumer discretionary slowdown, obviously, which may translate into layoffs as well for companies, which may translate into a soft landing recession. Inflation is okay, but we know that the jobs market is slightly slowing down. We have the election cycle. We have rate cuts coming up in September as well. A lot of uncertainty in the markets right now, which is why I don't think it's a very good proposition to be going YOLO on consumer cyclicals, aka consumer discretionary stocks, or even technology other than possibly the Mag 6. That's basically everything except for Tesla, right? So basically your Amazon, Microsoft, Google, Apple, things like that, Netflix, right? Meta. Basically, the Mag 6 is where I'm going to be doing most of my shopping, but the rest of technology, I'm kind of going to be giving a slight pause to it. I'm going to be very greedy with the levels that I choose to buy these companies at, because I think there may just be a little bit more pain coming around the corner. Now, in terms of our earnings, guys, before we get into more technical analysis, let's jump right into it. And we're going to start it off with the big boy of the bunch, and that is going to be Nvidia. So obviously, we've already stated that they are down roughly 7% in the after hours. But it's not because they didn't report good earnings, guys. They reported extremely solid earnings. The only thing that I could possibly find as a reason for the slowdown is their revenue growth rate is decelerating. But where is it decelerating from, guys? Well, it's decelerating from over 200% year-over-year comparisons. Last quarter was down about 120, and now we're coming into about 80% growth year over year, which is still fantastic, right? But a few of the companies that have been hit by this diminishing returns on growth recently, even though they're excellent numbers at face value, it is still a decline, of course. A few of them, most recently, have been Elf Beauty and, of course, CELH. Those are the two companies that have been growing revenues in excess, very high double-digit numbers, 60, 80, 100% year-over-year comparisons, and now are coming down a little bit more. That is the only thing in NVIDIA's entire earnings, guys, that I could possibly see as a reason for the decline, and also possibly repositioning away from growth more into defensives in light of potentially recession or recession narrative that potentially might just be looming around the corner. In terms of their numbers, though, guys, fantastic. Beat on EPS by about 5.36% and beat on revenue by 4.53%. $30 billion in revenue for Nvidia, guys. That is absolutely ridiculous in terms of their growth. Let's take a look at some of the articles right here. Nvidia reports 122% revenue growth on surging demand for data center chips. So once again, a fantastic revenue growth rate here, guys. But the problem is they're coming from a 200% revenue growth rate. So even this quarter is lower than prior, and moving forward, the next quarter will be about 80, 85-ish%. Still, fantastic numbers at a face value. So let's have a look here. Nvidia reported earnings after the bell that beat Wall Street expectations and provided stronger than expected guidance for the current quarter. So triple beat on revenue, beat on EPS, and they beat on guidance. No problems at all, right? And the earnings call with Jensen Huang was actually fairly bullish. No red flags there as well. Nvidia said it expects about $32.5 billion in the current quarter revenue versus the $31.7 billion expected by analysts. So there is your bump in guidance, very decent. That will be an increase of 80% from a year ago. So that's what I'm saying, right? Diminishing returns in terms of year-over-year comparisons in revenue growth. Completely normal, right? Now, revenue continues to surge at the chip maker, rising 122% on an annual basis during the quarter, following 3 straight periods of year-over-year growth in the excess of 200% range. Net income more than doubled to $16.6 billion, up from $6.18 billion. This is fantastic net income, gives them about 55% net profit margins as well, which is absolutely insane. Nvidia shares are up over 150% this year after soaring almost 240% in 2023. This is also something else, guys. The reason that Nvidia is maybe not up 10-15% in the after hours is simply because of their following guidance. Yes, they increased guidance versus the consensus, but it wasn't something like 34-35%, something like a 10% beat above the standard. When you are up over 150% on the year, guys, and the SPY is up only above 20%, you have to justify those returns by giving more and more ridiculous guidance to Wall Street. And when they don't get it, guys, that is when the stock comes under a little bit of criticism, of course. Revenue in Nvidia's data center business climbed 154% from a year earlier to $26.3 billion, accounting for 88% of total sales. Obviously, we all know that the data center business is now Nvidia's bread and butter, but their other segments have actually been doing quite well as well, and we'll take a look at that shortly in a bit in the video. It also topped the Wall Street expectations of 25.24, so they beat on data center revenue expectations. Much of its business is targeted at a handful of cloud service providers and consumer internet companies, including Microsoft, Alphabet, Meta, and Tesla. Why does this matter, guys? Because that is the bulk of their revenue, and we have had earnings from all of these companies so far, and every single one of these companies has said that they will continue to increase capital expenditures for AI and data center ramping capacities. So they are still spending money, no signs of slowing down from the hyperscalers just yet. Now, moving on, Nvidia said it shipped samples of Blackwell chips during the quarter and made a change to the product to make it more efficient to manufacture. This was one of the potential red flags leading into earnings. There was a lot of talk about Nvidia's potential delay of the Blackwell new series of chips, delays possibly up to 2-3 months. The company has come out and said that is actually not going to be the case. They are relatively in line with their original schedule of shipping Blackwell, so at least those concerns have largely been taken care of. In the fourth quarter, we expect to ship several $1 billion in Blackwell revenue, said the CFO of the company. And here's what Jensen Huang had to say about the whole issue. When I said start production in Q4, I mean shipping out. I don't mean starting to ship. So a little bit of a confusion there by Jensen Huang, which is what led to all the concerns, but nice for him to actually rectify the situation. Hopper demand remains strong, and the anticipation for Blackwell is incredible. Hopper is just their current generation of commercial grade chips, right, for those data center applications. Nvidia said its gross margin slipped in the quarter from 70 to 75.1 from 78.4. So tiny little slip, guys. Doesn't really matter too much in the grand scheme of things, though it's still up from 70.1 in the year ago period. For the full year, the company said it expects gross margins to be in the mid 70% range. Analysts were expecting full year margin of 76.4. So mid 70s is about 74, 75, 76. And the analysts were expecting slightly above that. So tiny little miss right there, but that is perfectly fine. Gaming revenue increased 16% from a year ago to $2.9 billion, beating the estimate of 2.7. Nice to see that their legacy segment, this is what they had been doing for, arguably 15, 20 years prior to their data center ramp. That sector was actually doing good. And here is another big one, guys. Nvidia said it also approved $50 billion in additional share buybacks. So that news definitely helped the stock price, but just not enough for Wall Street. The buybacks were enough, but the whole picture of the earnings, right? You would be very hard pressed to critique any portion of these earnings, guys. In my humble opinion, the only reason Nvidia is down is because there's really a hesitancy right now to bid tech and growth names to the sky as there once was back in April, May, and June of this year. So let's take a look at some of their business segments, guys, and you will see that they're actually very, very good. So here's our quarterly revenue trends. Data centers largely taking the lion's share of their revenue, of course, but the rest of everything was very, very decent, guys. Gaming has been steadily up, finally back, right? After a few quarters of flat, even declining growth, that is now back. Professional visualization is also up. Their auto industry segment is also up as well, and OEM and others. So all lines of businesses firing on all cylinders. No red flags right there. Let's take a look at their net income numbers, right? So this is their most recent net income numbers. 55.12% net income margins. That is absolutely ridiculous. That is slightly down from last quarter, though, where they had 57.1. But from a year ago, it is still up. A year ago, it was about 45.8. So Nvidia is still bringing in a ton of money to the bottom line. That is also because they have pretty much monopoly status right now, right? They really don't have any competitors whatsoever. Now, AMD is scaling their own version of what Nvidia is doing, but they are not yet up to scale, not yet up to the size that's required for these other hyperscalers like Microsoft, Oracle, Alphabet, and others, right? That is supposed to be slated to be done in 2025. So in 2025, Nvidia is going to be having its first taste of competition from AMD, which could bring the price of these commercial grade chips down, right? We all know what competition does. It usually brings the price of products down because right now, Nvidia, because there's so much demand, they can essentially charge whatever they want for their products. Their commercial grade GPUs right now that they're using for data centers should be retailing between $8,000 and $9,000 per unit. But Nvidia right now is selling them in excess of $25,000, $30,000 per unit, right? So they're artificially making a ton of more money than they otherwise would if there would be natural market competition. So we have to pay special attention to the prices of those units over the following year. Take a look at their free cash flow right now. Very decent free cash flow, $13.5 billion in free cash flow. That is very, very good, guys. Nvidia, I mean, they have been ramping up free cash flow. And what have they been doing with it? Well, now they just authorized another $50 billion in free cash flow. Let's take a look at some of their balance sheet history, right? So you can see free cash flow is that column in the middle. Last quarter was about 15 billion. So now at 13.5, a little bit lower than last quarter, but still an absolute crazy number in terms of free cash flow. You can see free cash flow has been growing. They don't really have that much debt in relation to the free cash flow and cash that they have on the balance sheet. So very, very healthy balance sheet overall for Nvidia. In terms of their forward growth rates, well, you can see the massive EPS ramp that they're currently going into for the next 3 years of time. Very healthy. Also massive revenue ramp as well. In 2027, they're slated to bring in about $230 billion. We will see if they can actually manifest these tremendous numbers, but so far looking good in terms of their expansion curve. But the growth rate, guys, the growth rate is always what's going to be front and center for investors for Nvidia, right? Can they retain that monopoly status that they have right now? Can they retain their pricing power as well? Can they retain their net margins, right? A lot of pressure on Nvidia to maintain those three things right now. So in terms of the valuation here, guys, well, the valuation is not too bad. As a whole, it's not too bad, admittedly. Revenue growth through 2027, growing about 23.5% per year. Very healthy. EPS growth through 2027, growing about 25% per year. Now, because of the couple issues that I've been saying, right, about rising competition in the space potentially, and Nvidia having to reduce its prices potentially as well, when maybe the market gets a little bit more saturated with these high-end commercial grade chips, well, the market, Wall Street is estimating 33% per year EPS growth, but I've tapered it slightly back to 25% to have a more conservative view. But 25% is still very, very good, right? I'm not being too conservative. Now, at a forward valuation for 2024 year end at $116, that gives them a P ratio of about 42.5. Not too bad, but when we divide that by their EPS growth rate, they get a PEG ratio of about 1.7. 1.7, guys, for Nvidia is not that bad altogether. So in terms of Nvidia, I've been saying it a few times on the channel, right? If the overall tech market and semiconductors continue getting hit over the next month, as markets continue to bleed, there continues to be timidness over a recession narrative, right? The place that I really want to start playing Nvidia again is going to have to be between that $105 and about $90 range, right? Up here, it's still a little bit too high for me, not because the company's doing well, but just because of what the overall market is doing right now. So we need to be very, very, very conservative on our targets for these companies, guys, especially in light of all the market uncertainty uncertainty to come. But as a whole, guys, very good quarter for Nvidia. I don't really think that, they deserve the 7.5% drop right now, but everybody knows, right? In times of uncertainty, sometimes the market can be a little bit irrational with their earnings, with their earnings moves, right? So that's pretty much everything for Nvidia. Hopefully you guys enjoyed that. Now let's jump into company number 2, and company number 2 is going to be another very beautiful company, Salesforce. So Salesforce coming in with their earnings after the bell, they are up about 4% in the after hours. So very, very decent performance by them in the after hours, and because they had very good revenue and EPS beats and tremendous guidance as well. So moving on, beat on EPS by about 9%, very healthy. Beat on revenue by about 1.18%. So all in all, guys, double beat there, and they did have very good guidance. Let's jump into it. Salesforce beats earnings estimates, and the CFO steps down. This is less important in my opinion. Let's just jump into the article. So the software maker reported robust fiscal second quarter results that beat estimates and raised its full year profit outlook. The company's revenue grew 8% year over year. Growth in average revenue per user, partly because of there was growth in average revenue per user, partly because of a shift to premium products. Now, moving on, net income at 1.43 billion was up from 1.27 billion. Very decent shift in net income. Now, with respect to guidance, Salesforce called for an adjusted fiscal third quarter earnings of $242 to $244 per share on 9.31 to 9.36 billion in revenue. Now, analysts had surveyed 2.43 in EPS, which is literally the midpoint of what the guidance is, and 9.41 billion in revenue. So there is a tiny little miss in guidance in terms of the total revenue amount, but the EPS is in line. So that tells me one thing, that their efficiency, their profits are growing, even though the revenue is not growing as fast. So the company is getting more efficient internally, which is one of the things that Wall Street has been asking them to do over the past 2-3 years of time, and they are now executing on those demands. Management called for 10.03 to 10.11 per share in adjusted 2025 earnings, with 37.7 to 38 billion in revenue, which implies growth of 8 to 9%. Last quarter's forecast was 9.86 to 9.94. So they did give guidance for the full year above the expectation for the EPS, right? Nice little bump in EPS right here by about 20% roughly, right? By about 2% roughly. Now, however, this is also where they fell a little bit short. The revenue guidance was 37.7 to 38. So once again, revenue guidance in line with expectations, right? They did not increase this one, but they did increase their expectation of profitability as measured by EPS. Salesforce's adjusted operating margin guidance for the full year is now 32.8, up from 32.5 in May. There are your efficiency gains. So we are assuming that the conditions we've been experiencing over the past few years persist. Executives have previously pointed to longer sales cycles and scrutiny of budgets. They are talking about companies cutting back, guys, on their software spending. Where have we heard this recently from other companies? Last week, we heard it from Workday, and prior to that, we heard it from Palo Alto. Companies are becoming very, very picky about how much money they choose to spend on enterprise software applications, and apparently that trend will continue for some time, as voiced by not only Workday, not only Palo Alto, but now Salesforce as well. And we have to trust them, guys. Those are pretty much 3 of the industry leaders in their respective segments. Earlier this month, activist investors Starboard and Value Act both disclosed increases in their Salesforce positions. Both bought shares before the company announced a widening of its adjusted operating margin sooner than planned last year. Why do these activist investors matter, guys? Because these activist investors have been asking Salesforce to do a couple of things. Here's what they wanted. They wanted less acquisitions from the company. So Salesforce is notorious for one of the only ways, the primary way that they used to grow is acquiring other business, acquiring their competition and assimilating their businesses into their own. That would give them revenue growth, EPS growth, but that growth was not so much organic, right? The other thing that they wanted to do, so it meant less acquisitions means more free cash flow because they're not spending that free cash flow buying other companies, right? They wanted less shares compensation for management and executives, and they wanted better cost management, better cost control, improving their efficiency and improving their bottom lines. CRM has now delivered on all 3 for the past 2.5 quarters running. So they are delivering on everything that Wall Street asked them to do. What has that caused, however? It's caused for a slight reduction in the revenue growth rate from double digits, 11, 12, 13%, to now under 10% to about 8, 9%. But that is okay. At least they are becoming a more efficient company. Now, moving on further for Salesforce, guys. So let's take a look at some of their earnings slides. So in terms of their GAAP results, you can see total revenue bumped by about 8%, subscription and support revenue up by about 9%, remaining performance obligations current in the current year, about 10% gain, $26.5 billion, which is fairly decent, guys. Salesforce brings in about $40 billion per year. That's about half a year worth in terms of current. Total remaining performance obligations, how much money they have in the pipeline for the future, is about 15% up now at about 53.5 billion. So just over 1 year's worth of revenue. That is very, very healthy for the company. Operating margin, they've improved operating margin by almost 2%, guys. That is not nothing, right? That is a very good improvement for the size of this company. Now let's move on a little bit further here, guys, in terms of some things that I want to highlight. Their non-GAAP expense profile. So you can see here, over the past 5 quarters, they have made some good diminishing or some good reduction in their costs. You can see here that in terms of sales and marketing percentage, that is from 30 to now 29%, right? They can obviously cut everything in half. So we need to see a streamlined reduction in costs, and it has been happening over the past 5 quarters. Their cost of goods sold from 20% down to about 19%, good there as well. Their R&D costs are the same. You would like to see these maintain the same, right? It is a software as a service company. They're trying to make a big push in AI, so they kind of need those that R&D spend, right? Here's another area of focus for the company that they need to do a little bit better on: the general and administrative percentage of revenue. It was 7%. It is still 7%. That needs to come ever so slightly down, in my opinion. But nice to see them make a little bit of progress here. And that progress translates into pretty much a roughly 2% improvement in operating efficiency. So quite healthy as a whole. And they have been returning a lot more capital to shareholders. $4.7 billion in the second fiscal quarter. Very, very good. Reduction of 1% in their outstanding share count. They've repurchased over $18 billion in shares since the $30 billion authorization. Now they have about $12 billion remaining out of that. So very nice for Salesforce as a whole, which gives them a pretty much a share count, right? Shares outstanding. This was one of the critiques of the company. Too much shareholder compensation, not enough buybacks because they didn't have enough free cash flow to do it. Now that they're focusing on free cash flow expansion, operating margin expansion, you can now see the share count is slowly starting to come down. So this is very good for the company. It is still elevated, but we need to see continued further progress on this. But they're doing a good job, right? Have to give the company, its praise when it is due. Here is your free cash flow number. So you can see what a nice increase they've been doing over the last year. This was pretty streamlined, and now you can see it's really starting to explode to the upside. So nice to see that. This quarter was still a decent quarter of free cash flow for Salesforce. So they are delivering, and here you go, their profit margin expansion as well, right? So you can see gross margins have been netly improving over the last 6-7 quarters. Their operating margins have really come up leaps and bounds, guys. They are now arguably the best that they've ever been in the last 15 years for the company. And the last chart down below, this is their net profit margins. That is also now relatively close to record highs for the companies, sitting at around 15% as of last quarter. So very, very solid report from the company, guys. Nothing bad to say about Salesforce as a whole. They really do deserve their little 4% bump that they have in the after hours. The management team is executing on everything that people ask them to do. So it's not as if you can ask them for anything else, right? In terms of their balance sheet, guys, well, their balance sheet is relatively healthy. Not too much debt in relation to the amount of free cash flow they bring in on a yearly basis and versus the amount of cash they already have on the balance sheet. So the balance sheet looks very healthy for me. In terms of your growth rates, so here you can see EPS steadily growing over the next 4 years, and the revenue as well steadily growing over the next 4 years. So no problems to speak of at this company as a whole, right? Now, in terms of the valuation, well, they are growing revenue about 10% per year through 2027, growing EPS about 16% per year through 2027 as well. So that gives them a PEG ratio at $267 right now of about 26.56. That's really not bad in terms of the company's historical averages, right? If we can pull it up right here, I'll show you guys the historical PE ratios for in terms of trailing basis, right? So you can see right here, they're always relatively high, right? And always the, as low as we can go right here. Well, these are kind of all wonky and all over the place right here, but usually Salesforce trades anywhere between a 35 to 40 PE. So to see them on a forward basis at 26, that is relatively cheap for the company as a whole. Not much anything bad to say about that. And when we divide this PE ratio by their 16% EPS per year growth, we get a PEG ratio of about 1.66. Not all that bad for the company here, guys. So what I'll be looking out for on Salesforce moving forward, because the valuation is fairly cheap, in the event, guys, we get some further pullbacks in the overall market, and I can find Salesforce once again between 245 all the way down to roughly 230. This little zone of support down there, I would be interested in playing this company as a whole, guys. I think they're very, very healthy, still respecting our monthly uptrend. If we get a little bit more consolidation and we come into a monthly tightening range, as we get a little bit more market timidness, I would not be opposed to picking up a few shares of Salesforce down here. Very, very solid earnings report from a very, very solid legacy company. Now, earnings report number 3, guys, we're going to be going into CrowdStrike. So CrowdStrike down in the after hours here today, about 2.55%. There was a lot of emphasis, obviously, over the most recent quarter on the global outage that CrowdStrike unfortunately did when they rolled out their update, which pretty much crashed all the servers associated with Microsoft computers, and then people could not access their devices. They are now being sued by a host of clients and companies alike that were affected by that cybersecurity outage, essentially, right? For that 1 day's worth of time. Delta Airlines alone suffered what they're claiming to be an excess of $500 million in damages for that 1-2 day event from CrowdStrike. So that was going to be the emphasis of the earnings call, and the company delivered good numbers, however. So we're going to take a look at both of those things now. In terms of the numbers were very good. Beat on EPS by about 7.4%, and they beat on revenue by about 0.58%. Now they gave a little bit lackluster guidance because they are going to have a little bit more expenses and costs associated with the legal actions because of that outage, right, back a few months ago. So here we go. So CrowdStrike beats quarterly consensus, but lowers its full year guidance. Let's get into it. So the cybersecurity software maker reported strong fiscal second quarter results, but reduced the full year guidance in the wake of the global outage. CrowdStrike's revenue grew 32% year over year, very healthy number. The company recorded net income of $47 million, compared with only $8.47 million in the same period last year. Annual recurring revenue was $3.86 billion. That was above the consensus of $3.85. Tiny little beat right there. Let's get into the meat of the article. Shareholders have filed suit against the company and Delta Airlines, which cited $380 million in lost revenue and $170 million in costs and compensation because of the incident, said it will seek damages. Travelers have filed class action lawsuits against the CrowdStrike as well. All customers are looking for some kind of a discount, said a few analysts, right? Now, for the 2025 fiscal year, CrowdStrike now sees 3.61 to 3.65 in adjusted EPS and 3.89 to 3.9 billion in revenue. That is down from the forecast in June. Once again, a lot of this EPS crush is going to come from discounts issued to customers. Now, the prior consensus was 3.93 to about 4.03 in EPS. That is a 10% haircut in EPS, guys. That is a very, very big haircut. And revenues are the same. So no real change in revenues, guys. 3.98 to 4.01. That is a tiny, tiny, tiny little miss on revenues right there by about 2-3%. So the full year revenue guidance includes a negative subscription revenue impact of $30 million in each quarter and professional services revenue in the high single-digit millions of dollars for the second half of the year because of incentives for a customer commitment package, according to the statement. The adjusted guidance excludes costs related to the outage. So not getting quite the full picture, but they are having to give customers, existing customers, some discounts right now for the recurring revenue subscriptions. So CrowdStrike mixed guidance for the most part for the remainder of the year. Now let's jump into some of their earnings slides, guys, right? So one thing before we get into this, right, we know that they had a massive outage and we know that their stock price got heavily hit by it, but this is not going to be an everlasting event for the company. We need to focus on what the company is doing well. They are improving all metrics where it counts. this company used to be unprofitable. Now they have been profitable for roughly 4 or 5 quarters in a row. So they're improving efficiency. They are also growing top line revenue and annual subscriptions from their customers. The company is doing everything possible to move in the right direction and is still growing at fantastic rates. So this is another company that is suffering from temporary headwinds right now, but does have long-term viability for continued appreciation. So it is still a fantastic company over the next 5 to 10 years, in my humble opinion. Let's get into some of the slides, shall we? So here's your annual recurring revenue, up 32% year over year. Operating margin up about 2 percentage points. That is very, very good as well. And free cash flow, positive free cash flow once again, of $272 million. That is up 44% year over year. I will remind you, this was not always the picture for CrowdStrike. Let's look into their margins. Up until last year, guys, 2023, they were always net margin negative. And now, as you can see, over the past 4 or 5 quarters, they are now net margin positive, moving in the right direction. And pretty much the same thing when we take a look at, excuse me, that's the wrong one. When we take a look at their free cash flow, right? Used to be very, very, very slim free cash flow. They have now been improving their free cash flow profile on a year-to-year basis. So the company is doing everything it can to move in the right direction, and they are executing on their, on their business model almost flawlessly, right? If it wasn't for that global outage, that one-time event, guys, they're really doing very good execution of this business model right here. They have a huge total addressable market of about $225 billion, nothing to shy away from, right? Now, customers are embracing the Falcon platform, 65% with 5+ modules, and $100,000 customer, right? Have 8 modules and plus 48% growth right there. Very, very good in terms of the adoption rates. So, all of their platforms as well have been performing quite well. Cloud security, identity security, and log scale next generation SCIM, over $1 billion in ending annual recurring revenue. That is 85% year over year growth. So CrowdStrike, right? They have a number of different product segments. If you want to take a look right here, they have about 7 different product segments, right? So the 3 biggest ones have been growing in excess of 85% per year. That is absolutely fantastic numbers, if you ask me, in my humble opinion, right? In terms of our last slide that we're going to take a look at here, guys, their growth at scale, right? Here is your annual recurring revenue bump. Very, very good. Adding a little bit net new ARR over the course of this year. This is the net new additions, that green line right here. This is the expression of that. 11% growth year over year, guys. So very, very healthy in my humble opinion. Subscription revenue as well is up 33% year over year, which gives them total revenue bumps right here of 32% growth. Extremely healthy numbers, guys. There's really nothing to say bad about the company, right? The gross profit is moving to the upside, 35%. The operating income is moving significantly higher here, 46%. EPS moving in the right direction, and the free cash flow moving in the right direction as well. So the company is really operating, firing on full cylinders right now. Take a look at your historical profit margins for CrowdStrike. You can see gross profit has been relatively stable in the mid 70s. That is set to continue to maintain these levels as well. Operating margin used to be negative. Now finally positive. And this quarter it was positive as well. These are using GAAP numbers. So I know you might have seen 25, 30% in the earnings slides. These are a different accounting standard, but we can use either or, right? The moral of the story is that the trend is moving in the right direction, right? And their net margins as well, they had been negative prior and now finally net margin positive for the last few quarters in a row. So the company is doing the best it can with the hand it's been dealt, right? Their free cash flow also moving in the right direction, guys. Used to be negative prior to 2020 and now positive free cash flow. So looking very good for the company, guys. Nothing bad to say about CrowdStrike other than those short-term headwinds and short-term negative sentiment around the company because of that outage. But we know how those things work, guys, right? That kind of goes away after time, right? But it's not a snap of a finger that's going to solve those temporary issues for CrowdStrike. It's probably going to take another few quarters for the sentiment to really come back to what it was before the problem happened right here. So in terms of the valuation, guys, well, the valuation, CrowdStrike has always had a little bit of valuation concerns, right? They trade extremely rich because they're one of the industry leaders and because their growth rates are so high. Now, their revenue growth rate through 2027, about 21% per year. EPS growth through 2027, about 25% per year, gives them a forward PE at 255, about 70.2. Seems high at a first glance, but when we divide this by their EPS growth rate, we get a peg of 2.8, guys. very, very high for CrowdStrike. Now, it's not what it was up here. That was in the threes, and that was excessively high. Now it's a lot more manageable. What I would like to see on CrowdStrike, guys, I would not mind positioning myself in this company for the long term at least, but what I would like to see is maybe some additional discounts, right? The area that I'll be targeting on CrowdStrike myself, if you guys want to know it, will be this lower location right here, right? 245 down to about 220. If we can revisit these lower levels, that is where I will contemplate potentially making a few more plays on CrowdStrike right now. But we know, guys, we know that growth as of lately has not been hot in the markets. I would not be surprised that even though such a solid company that is growing at the rate that CrowdStrike is growing right now, I would not be surprised that if the QQQs decide to continue selling down, grinding down to the downside over the next month, 2 months, right? I would not be surprised if we do revisit those lower levels, and that's where I will be waiting to shop for this company. So hopefully that's been helpful for CrowdStrike earnings. That's pretty much everything we had for our earnings calls today. Hopefully you guys enjoyed that. Now let's dive right into our technical analysis, right? So moving on in, guys. So we were expecting this slight little pullback in the event of a miss on Nvidia earnings. So tomorrow we will have to keep a special watch on this level right here, guys. We are literally at this level right now, roughly, right? 555. This is going to be the level to watch. If we do lose these lows right there, it would be a daily downtrend underway on SPY, and that means that weekly consolidation is underway. It looks like it's already underway, guys, but it could just move a little bit down further. Where could we maybe be targeting, guys? Well, I've been highlighting this location for a while. That's going to be 546 down to about 538, right? Where this big prior zone of congestion has been in the markets could be a likely area for the SPY to pull back into, right? Looking for a possible weekly higher low for possible trend continuation. The size of the bounce on SPY is not negligible. It is very, very good. The bulls have a lot of space. Now they have to convert that space into a new weekly uptrend. So we will be watching for some dip buys in this lower location right here. The 12 EMA on the weekly is sitting there as well. Moving on to the QQQs. Now, one thing before we move on to the QQQs, just before I forget, right? The SPY is not yet at new all-time highs. What is at new all-time highs? The relative weight S&P 500, right? So this one is your S&P 500 equal weight index. So if you remove the sheer weightings that all of big tech has and you put all of these companies on the exact same weighting in the S&P 500, well, this is the ETF that shows it. And this one is at the all-time highs right now. So it shows you that a lot of the drops recently have been in the top heavy section of the market. We have a lot more names in the market that have most recently been green than red. It's just the size of these companies that are red drag down the entire portion of the index. Very, very interesting thing that I noticed as of recently, right? In terms of the QQQs as well, QQQs having a little bit of a slide. QQQs have already been in a daily downtrend, and we noticed this as of yesterday's session. So daily downtrend simply continues. Where can we possibly end up here, guys? 464 down to about 456. We are possibly looking for that inverse head and shoulders. So if you do continue, guys, looking once again for that weekly higher low for that possible further trend continuation, going to be paying special attention to this location right here. What do we have in remaining for data for the week, guys? Going to be a few big ones. GDP tomorrow. This is the revised number. We already got this one about 3-4 weeks ago at this point. They are revising it right now. They do this every single quarter. So we'll see if it's a big revision to the downside. It may just hurt the markets. And then on Friday, we have the PCE inflation report as well. So two things that could impact your markets positively or negatively. If they do impact it negatively, we will see how the markets react in these lower big support zones for the QQQs. But all in all, I wouldn't rule the bulls out just yet, guys. Still relatively healthy consolidation after the size and significance of our most recent move higher. Now, moving on to XLF, give me a very brief second. All right, so moving on to XLF. XLF up about 0.25% on the day. Continues to be one of the bright spots of the market, right? Very healthy daily uptrend right now. As soon as this move tops out, and keep in mind, we're getting close to daily overbought conditions on the RSI. So as soon as this move tops out, guys, undoubtedly going to be waiting for a higher low. Anything pretty much above 43.57, looking for that daily higher low. Could be an interesting retest of our prior all-time highs. Would not be surprised if we do consolidate into that area. Then it's up to the bulls to save this move and continue the daily uptrend. In the event we lose and roll over, guys, just remember we have tons of space on the weekly here, guys. Tons and tons and tons of space. Anything pretty much above 40.6, just looking for a weekly higher low for possible further trend continuation. So this is what I like to see, guys. When QQQ is in a little bit of a lull, semiconductors are in a little bit of a lull, some drawdown, what has been keeping the SPY from falling off a cliff? XLF, and the next one, XLV as well. So hopefully, when XLF moves to the downside and retraces, XLV moves to the downside and retraces, hopefully we get some price action in QQQ to the upside, because if not, the SPY is going to have a heck of a tumble as well. Moving into XLV, so XLV continues to put in some other gains. We are now pretty much, right, coming up on, what is this, right, of almost higher highs every single day, pretty much the last 3 weeks of trading. So we are due for a pullback eventually on healthcare, but it's looking very, very good as a whole. Anything pretty much above this point right here, anything pretty much above 149, going to be looking for a daily higher low for possible further trend continuation. Where can we pull back into? The first stop is going to be 154. We have not built that much support up here. However, on the way up, in the event we roll over further into a daily downtrend consolidation, just understand that as well, similar to financials, a lot of space on the weekly, guys, for some retracements right here. Anything above 145.51, looking for a healthy weekly higher low for possible further trend continuation. I would be more keen to wait for a larger retracement on healthcare, possibly coming down to 151, 150 before throwing in some bids, because there's a lot of companies that have just been outperforming recently, putting in all-time high after all-time high after all-time high, and eventually they will have to consolidate, right? We've seen it with UNH. UNH still hovering above its all-time highs right now, looking very good, but slightly extended. Eli Lilly putting in new all-time highs as well, but slightly extended. Another big one in this space, AbbVie putting in new all-time highs. Seems as though they do it on a weekly recurring basis, but still slightly extended. So keep that in mind here, guys. One of the other sectors that's been outperforming is XLP. This is your defensive sector, consumer defensive, Walmart, Costco, Procter & Gamble, Coca-Cola, things like that, right? Tobacco companies. Very solid industry as a whole as of recently, as we continue noticing the rotation out of the QQQs, out of consumer discretionary like the Nikes, the Starbuckses, even though their share price has been up recently, but you guys get what I mean, right? Into more defensive names. Those are still relatively close to the all-time highs right now. Moving into SMH. SMH, well, obviously tomorrow is going to be a fairly red day for SMH, down 1.68% on the day and down 3.71%. Now, we'll see how this one responds to the price action tomorrow, but one thing's for sure, now in a daily downtrend after getting rejected on our zone of resistance, 257 down about 247. So looking for the continuation of the daily downtrend, and now we're coming into the big area of support again, 237 down about 225. We're roughly midway through there now. Still possible for an inverse head and shoulder setup. So we will keep an eye on how the price action responds to this lower location right here. But daily downtrend definitely confirmed right now. What are we looking for, guys? Still looking similar to the QQQs, looking for the weekly higher low setup for the possible trend continuation. Pay special attention to this 225, guys. 225 is very important. It's the bottom end of our prior. This used to be all-time highs back in the day, right? This level is where most of your support is. That is 225. Need to see the bulls hold the 225, the bottom end of the support, if they want to have a chance, guys, at regaining the weekly uptrend. Because if you pull back too much of this move, you set up for either a tightening range at best, or at worst, if you pull back too much, then you can revisit the lows and maybe even reset into a weekly downtrend. That would definitely not be good for SMH. So we'll keep a very close eye on the price action, guys. But now is not the time, in my humble opinion, to be going YOLO on semiconductors. They need to give them some time to consolidate. Let the deals come to us, right? A few of the deals that I'll be eyeing in the near-term future, guys, right? AMD, we're going to go over this one shortly, but AMD, love it if it consolidates further. Lower 130s, high 120s, I'm definitely going to be a buyer. Micron as well. Micron, mid 80s to low 80s. I would be a buyer of Micron down there too. Getting into some nice deal areas. TSMC, if for every which reason TSMC comes down, we can see 150 again, lower than 150. I'm a buyer there. ASML as well. ASML, if we start revisiting these lower locations down 850 all the way down to roughly 775. I'm a big buyer of ASML in those locations right there. Tremendous zone of support. So looking forward to buying the dips on semiconductors. Just be very patient with your buys and go small, guys, right? small dollar cost average. Do not blow the entire cash reserves that you have right now, because the potential recession catalysts maybe have not even started yet, right? So we need to be patient, very, very patient with these things. Moving into IWM right now, give me a quick second. Sorry guys, all those earnings, right? Getting a dry throat there. So moving into IWM not looking the best right now, 0.68% to the downside, guys. And as I said, right, growth is really becoming under scrutiny. If Nvidia cannot get it done, even them, do not expect the IWM Russell to rally to all-time highs anytime soon. I really do think we're probably going into some weekly consolidation. At best, the bulls will maybe be able to maintain a tightening range. As of now, though, they have not lost the daily uptrend just yet. So the bulls are still in control, trying to set up the daily higher low. Anything above 212.23, looking for that daily higher low for possible revisit of our most recent 52-week highs, guys. But those 52-week highs is your big area of resistance, 2020 and 2021. I would be very surprised, guys, very surprised if the bulls are able to get through that with so much economic uncertainty ahead of us. If anything, the best we can probably get is a tightening range right here. And obviously the worst we can get is completely giving back the entire rally we've had in the last 3 weeks. So I am interested in playing growth stocks, guys, but unfortunately for anybody who's bullish on IWM watching, I'm going to be very conservative. If for ever which reason, at a certain point or the next few months, I don't know when, I don't know if it's going to happen, but if it does happen, I will be looking for some entries on IWM, but I need it to become closer to about that $190 range. So just keep an eye on those growth names. But as a whole, guys, very tough to position up here, right? We're kind of in between. If you try to take some longs up here, you're running into massive resistance, 52-week highs, and massive resistance of the last couple of years. And if we try to take some shorts right here, right? Well, the shorts could be a decent little opportunity, but maybe not, maybe not the best downside, because we do have some very massive support right here, possibly just stuck in this range right here for the next foreseeable future, the next couple of weeks. Moving into the Dow Jones right now, Dow Jones down about 0.39% on the day. So the Dow Jones holding up better than most, still in a very nice daily uptrend, but just keep an eye, guys, on these higher lows right here, 40,600. In the event we lose these higher lows, well, daily consolidation is underway, opens up the door for the daily downtrend at that point, and unfortunately then we will be under weekly consolidation, but weekly has a lot of space too. This one looks like financials and healthcare, right? It is a defensive index as a whole in terms of their positioning, right? So anything above 38,500, looking for that weekly higher low for possible further trend continuation. So the bulls still look good, guys, but with tomorrow's price action, right? I don't have the futures up on this one, but for tomorrow's price action, we may get some visits of these lows. And if they roll them over, just expect possible consolidation into this location right here, which is your prior big resistance zone. All in all, the Dow Jones looking relatively healthy, if I do say so myself. Now, moving into our big tech names, shall we? So moving into Apple, Apple down for a change, 0.68% to the downside, tried to eclipse our most recent range highs, but not quite able to close and break above. So we will see how Apple is impacted by the tech sell-off tomorrow. One thing's for sure, we need to keep a close eye on this lower location right here, 223.60. Lose this to the downside without putting in higher highs, closing higher highs, that would be a daily downtrend, and then we would be looking for maybe some weekly consolidation. Where can we pull back into, guys? Well, anything pretty much above 195.46, looking for a weekly higher low for possible further trend continuation. I would keep a close eye on this first line of defense right down here, this big support box, 220 down to about 215 for Apple. So we will see how the bulls respond to that location, but I am not going to be looking to play Apple down here, even though they do have a potential inverse very long second shoulder, right? So kind of like a deformed shoulder right there. They do have that on the table right now. The reason that I cannot play Apple is simply due to the valuation, right? Companies with high valuations right now have been being punished. The only one that is not being punished is Apple, obviously because it's a legacy company. It's a Wall Street darling right now. However, we have to acknowledge that there are some valuation concerns. And if Apple's share price compresses because of these valuation concerns, well, then I would be expecting a revisit of possibly the $200 levels right there. And that is where I will be patiently waiting to play Apple. Don't feel bad for me, guys, if it rallies too much. I have a ton of Apple shares in my long-term portfolio, but I'm talking about some swing trades, right? I'm being very careful with my swing trade area selection. I need to see some better discounts on Apple for me to get interested for those. Moving into AMD. So AMD, of course, down slightly today, 2.75%, and down an additional 3.68% in the after hours. So that would put us all the way down here. Unfortunately, AMD now coming into a daily downtrend. We know we got rejected very, very hard at the 163 down to about 155. This big red box of resistance, right? So now we have a level to protect here, guys, right? We're coming up on a very important level, which is the 137 range. You can see it's where we tried to form a bottom, acted as resistance for 5-6 days of trading, and now could be acting as our next line of defense support. So we are very close to that location right now. We will see how the price action happens over the course of the day tomorrow, right? But daily downtrend definitely underway. What are we looking for, guys? Still looking for a weekly higher low. Now, obviously, the size of the bounce so far in terms of the weekly bounce to the upside was good, 61.8. So the bulls do have some space to set up for the weekly higher low for possible trend continuation. But if we break below 137, guys, it's not going to look good. The bears will take back too much of this move at that point. And even though we're coming into an overall bigger area of support, this green box, right? 142 down to about 129. You don't want to see the bears take back too much of this move, guys. It opens the door for a revisit of these lows, or maybe even if they don't flush it right away, they can just reset with some momentum lower and then flush it at a later date, right? So AMD, very unfortunate that they get dragged down by those Nvidia earnings, but that's just the nature of the game right now, right? So for AMD, I'm still going to be interested in playing some swing trades, and that will most likely be a revisit of these lower locations right here. I'll be playing this on a weekly basis, guys, and I'll try to give myself as close as possible to an 8 to 10% margin of error. So if we're trading right now at about 140, I want to be looking at about the 130 strikes for some short puts. If we come lower than that, then obviously we have to adjust our profit targets lower. All in all, though, guys, 130 down to about 120. I do believe it's a very nice location to make some initial entries on AMD. But as I said, we need to be patient. We need to be conservative with our targets as a whole. Should be a very good year for them in 2025, but maybe just at least over the next 3, 4, 5 weeks up until those rate cuts, there's going to be a high degree of uncertainty. So we might just see some price action once again come down into the low 130s. Moving into Amazon. Amazon as well, down about 1.34% today, and in the after hours was down a little bit more. So Amazon definitely in daily consolidation mode right now after a beautiful 12, 13 days of rally, just coming off the top ever so slightly, hunting for the daily higher lows. Anything above 151.48, looking for those daily higher lows for possible further trend continuation. However, pull back too much of this move, guys, you open the door for at best a tightening range, or at worst, a potential daily downtrend. If we do get the daily downtrend, I'll remind you what we're looking for the bulls to set up for the weekly higher lows for the possible weekly trend change, right? We know the size of the bounce on Amazon was okay. It was a 61.8% bounce, so it does give the bulls a decent chance to reset this into a weekly uptrend recapture. I will be targeting for Amazon the next set of locations I'm looking at to make some plays for some short puts. Probably for next week will be around the 165, lower 160s for some trade attempts. That is going to be a nice area, guys. It's pretty much the previous all-time highs, which are now still acting as support for the company. The 50 EMA is right there as well. And Amazon, I mean, anytime we can find Amazon, guys, at a discount of 17% from the all-time highs, usually a good proposition to be buying this company. So we'll see how the price action evolves over the forthcoming weeks. The one thing we would not like to see for all these companies, guys, is the bears take back too much of these moves, because then you just open the door for the actual weekly downtrend and the actual, big monthly consolidation reversion. If for ever which reason, I'll just put it out there, guys, if for ever which reason we see Amazon in the lower 150s all the way down to about 140 in the next month, 2 months, if the markets really take a beating, this is where I'm going to really go heavy on some Amazon leap call options. Moving on to Google right now, Google down about 1.13%. So Google as well now setting up into a new daily downtrend. We had the daily uptrend going. Fortunately, we lost that pattern now into a daily downtrend. So what are we looking for? We're looking for, once again, weekly consolidation on this stock. So Google's bounce was not as good as the rest of big tech, guys. Google's bounce was only a 38.2% bounce. That is not going to get the job done. So now the probabilities favor the bears, as a matter of fact, for a revisit of the lows or breaking lower. So I'll be paying special attention to how we start reacting, guys, at these most recent lower support levels, talking the 161, 158, the 200 daily moving averages right there, right? If we just smash through this in 2-3 days as if they're not even there, then it tells me that most likely the bears do want to revisit possibly the lower 150s around 152 all the way down to about 145. That is really where your next big level of support from Google comes into, prior all-time highs, prior congestion area right here. That is most likely going to be where we end up stopping. That would be a massive weekly downtrend and fair bit of monthly consolidation. It wouldn't yet be a monthly downtrend because the bulls still have a lot of space, right? But would be a heck of a consolidation on Google. I'm still very interested in playing Google, guys. I will make several attempts trading it in these lower ranges right here with some short puts, but in the event we are not able to get that bounce reversion from there, then we will have to reset our zone for ideal trade locations down here in the mid 150s. Moving on to Meta right now. Give me another quick second. All right, so moving into Meta down about 0.45%, actually coming down the least out of the bunch, right? Just because Meta's fundamentals are absolutely amazing and their guidance has been amazing as well. That being said, they are not immune to overall market weakness, so we'll keep a close eye on how their price action evolves over the next few days and few weeks worth of time. So we know we're coming off of a massive bounce, daily uptrend into all-time highs breakout attempt, and unfortunately, we just rolled it over. So one of two things is going to happen here, guys, right? Either the bulls are going to be able to V-shape this, all-time highs. At that point, we're going to be able to have a possible breakout, retest of the highs, and run trade. That is usually a very high probability setup, but we are still dealing with this annoying resistance right now. 532 down about where we are right now, 514. Still unable to break through it after multiple attempts, right? 1, 2, 3, and now 4, 5 attempts at this zone of resistance, just not getting it done. Just goes to show you guys, when the overall market is very timid, it's very tough for these legacy companies to be pushing all-time highs after all-time highs after all-time highs. So now moving on further, guys, what are we looking for potentially on Meta here? Well, in the event we continue our slide, possibly even looking out for this zone to act as resistance once again, maybe lower high, maybe even the lower low rollover. That would just be looking for possible weekly consolidation after such a very healthy move by the bulls, maybe just some time to consolidate. This would be a weekly cup and handle. If we can consolidate in a shallow fashion, could be looking to reset into a weekly uptrend. I will be looking personally, guys, if we can get all the way down back to about 495, 490 seems to be a very good location at that point. We will be able to write some puts either down here, write some put credit spreads, or maybe even go with some light call debit spreads, right, to make that weekly trend change attempt by the bulls. So that is the location that I'll be patiently waiting for Meta to come down into. So far, though, the bulls not looking too bad. We'll take this one day at a time. Moving into Microsoft right now, Microsoft down another 0.78%, and Microsoft as well, right, really had a nice push here in the last couple of weeks of trading, that has now come undone. We got rejected at this big area of resistance, 436 down to about 423, and that area is going to be a heck of a difficult one to get through, in my humble opinion. Now, we had the daily uptrend. We have now lost the daily uptrend by flushing these lows. So the expectation right now might just be for a lower high attempt on any bounce, possibly into lower lows, and maybe into just further weekly consolidation. I will remind you, the bounce on Microsoft, similar to Google, was not the best out of the bunch. They only had barely a 50% bounce off the highs, so it does set up the bears for maybe another attempt at breaching the support below us. 402 down to about 392. This is the location that I really start getting interested in playing Microsoft, guys. If we come down, we're now almost in my area. I was looking for below 410, preferably as close to 405 as possible. If we get closer to 405, it's going to free up a bunch of put credit spreads in the lower 380s and also possibly free up an opportunity for some call debit spreads to give the bulls a chance at this weekly trend recapture, right? I'm not ruling out the bulls just yet. I do want to make an attempt on all of these names for the weekly higher low attempts, right? We're looking to play that, but if ever they do not play out and we get stopped out, then we are going to have to reset our expectations slightly lower on Microsoft, possibly down into the 380 locations. So Microsoft as a whole, not looking too bad. The bulls still have a lot of space, and I would not rule out this massive support area that has been support all year for the stock. So coming into a slight buying opportunity, and for a long-term portfolio, guys, Microsoft at this point is a nibble for me. Moving into Netflix as well. So Netflix down about 1.71%, cannot get the breaks of the all-time highs, unfortunately for them, right? So what we're looking out for on Netflix, especially into tomorrow, is a loss of these lows. You can see equal lows as of today, looking for maybe that daily downtrend rollover after failing the all-time highs after 2 attempts. May just be time for some weekly consolidation on Netflix. This chart kind of looks like Meta, right? Big recapture, hesitation at the all-time highs, and then fail. Could be the exact same thing that we're setting up for, but Netflix has a lot of space here, guys. Anything above 585, looking for that weekly higher low for possible further trend continuation attempts by the bulls. I would be looking at this location right down here, 656 to about 636. That could be an area that the bulls are maybe looking to form a base of support into before making a second attempt at the all-time highs. So Netflix, not looking too bad in the grand scheme of things. I would not rule the bulls out just yet, but in the event they get rolled over with the rest of the market, this is the area that I'm most likely targeting for some bounces in Netflix. Moving on to Nvidia right now. So Nvidia, obviously, we went over them for earnings, down about 2.1%. I do not have extended hours right now, so let us put those on. Where did my button go? Never mind. So they must be down about, let's go have a look here. They're down about 117. So 117 not looking too bad for the stock right now, but they were still in an area of support. These bulls tomorrow have a lot of work to do. They have to protect this 120 down about 115, right? This is the area we're looking to hold. It is your most recent big level of weekly support. The weekly 12 EMA is right there as well. And that could be the cup and handle attempt for Nvidia bulls right there. Come any lower than that, and you kind of ruin that pattern as a whole. And the bulls will have a lot of work to do, guys, to get this trend back to the upside, right? So really playing with fire right now for Nvidia. Daily downtrend, unfortunately, will be underway as of tomorrow, and we are looking into weekly consolidation. In the event we start breaking and closing the weeklies below this here, guys, at best, probably what we can get is maybe a tightening range, right? If you give the bears too much room to the downside here, the momentum of all this move is very tough to V-shape like that, especially since we have no more catalysts, and the possible catalysts that we have coming up, guys, are all not very good right now, right? We know there's a lot of timidness, a lot of recession fears, so it's not as if we're looking forward to extremely positive catalysts that these markets can maybe just V-shape any total loss of momentum, right? So that's not what I'm looking for. In the event we lose those levels here, guys, and we start trending lower and lower, you guys know the levels that I'm looking out for. 105 down to about 90 is my target desired location for Nvidia right now. That's going to be for both short put applications and maybe the ultimate bounce zone if we do come down into there, guys. Maybe some call debit spreads, because I wouldn't rule the bulls just out. I'm not expecting this, right? But maybe just a tightening range for the bulls as they grow into their valuation. Nvidia can consolidate sideways. People might not remember, but there was a time last year, right, where Nvidia consolidated sideways for literally a better part of 4 or 5 months, right? We could possibly see something similar being rolled out as the company just goes through, some valuation concerns and growth concerns and stuff like that, and overall macroeconomic concerns for the entire market. That would be the best case scenario in my humble opinion, which is why I'm going to be a bit patient and wait for my levels to appear down here. If they don't, if we just bounce from here and move to the all-time highs, perfect, no problem at all. That would be the inverse head and shoulders pattern that we're possibly looking for. However, I'm going to be very patient and picky with my levels for growth names, especially leading into all this uncertainty. So Nvidia, we'll see what happens by the end of the week. Now moving on to Tesla. Tesla down about 1.65%. Daily downtrend on Tesla underway. They had a beautiful daily uptrend right here and unfortunately just lost the actual pattern. So at this point, guys, probably into that massive zone of consolidation, as I was saying, right? When you lose all of the momentum, it's almost impossible to entirely V-shape this move. The best you can get usually is a tightening range, and the worst you can get, of course, is the weekly trend rollover. So I'm anticipating one of those two scenarios, either the weekly tightening range or the weekly rollover, which is why I am not playing any Tesla unless I see some better prices. If we move down lower into the, high 190s, mid 190s, that might open up some short puts, put credit spreads and stuff like that. Down in this lower location, think lower than 180, 175 is where I really want to base a lot of my trades off of on Tesla right now, just because of the economic uncertainty, consumers pulling back on spending and big ticket items. So we really have a tale of two things for Tesla right now. Rate cuts, which are going to be good for the company, but we know rate cuts do not stimulate demand, guys, with the snap of a finger. It takes a very long time for that to happen, right? So Tesla right now, still a pass for me. The bulls not looking too bad, but I would like to see them protect these levels 183 and kind of tighten up within this 230 down to about 195 band, right? This is the large area for Tesla. Would not like to see them lose that, because then we really get into very risky territory, right? Down to the lower 170s. And that could be very, very risky, but that's where I want to take a position on the company perhaps because the valuation is much more manageable. And now lastly, moving into Palantir. So Palantir down about 1.56%. They're slowly coming into the desired target range. I'll remind you, what are we looking for here, guys? Massive rally, looking for a pullback. Where are we looking for the pullback? 29 to 28. Prior resistance right here, but most importantly, big prior resistance from 2020 and 2021. So that's the expectation. That's what we've been looking for the past roughly 2 weeks of trading. Happy that I've been patient and waiting for it because now it is almost here. So in the event Palantir pulls into this location, daily downtrend perhaps, or just in one clean move, it might free up some short put opportunities below $28. Think $27, $26 perhaps, all the way down here. Palantir not looking too bad. Even on the weekly gorgeous uptrend right now, looking for the weekly higher lows. At this point, anything above $21, looking for those weekly higher lows for possible further trend continuation, guys. I'm going to be picky on Palantir as well. Love the company, but the valuation right now, especially above 30, is quite rich. So if even Palantir, even a solid company like them, gets brought down by overall market weakness, I will be patient and I will be waiting here, guys, in the mid-20s location. I think the valuation is much better. We have a much larger, recent price support action, right? I know this level is very, very big, but if we lose this one, we're most likely going to go down to the following one, 26.25, and that's kind of where I'm more in tune with buying this company, or at least making some swing trade attempts. So that's pretty much everything we had for today's video, guys. Very, very important to keep a close eye on our price action following GDP and following the Nvidia earnings aftermath over the next 2 days of trading. Those will really give us some indications on whether or not we are looking for some potential further big weekly drops, right? Or whether or not this is just a little blip in the whole momentum rally for the bulls. So the next few days are arguably very, very crucial. And the steps that I've been taking, guys, in light of this uncertainty, is making a lot more plays on value-based companies and being very, very picky with the levels and especially the companies in tech and growth that I'm choosing to play. Now, keep in mind, if you want to know directly which companies I am playing and the ones that I'm looking to play in the futures in terms of trade setups and like that, well, you can obviously join our private Discord that we have down below. The link in the description is right there, where I do share my trades, my trade ideas, my macro ideas as well. We chat every single day in there, pretty much all day. And we also do private market live streams where we go through a lot of more of these elements in detail and a lot more companies than you may see as well in these videos, more in detail too. So if you're interested in that program, the link is always down below in the description. If not, guys, well, feel free to like the video. I would really appreciate it for the growth of the channel. Also, feel free to subscribe to the channel if you're new. We do these video recaps every Monday to Friday, so hope to see you back in the future. And then, of course, if you have any questions, guys, as usual, especially in times of uncertainty, I highly suggest dropping me a line down in the comment section, right? Anything you want. If you want me to look at a stock, technical analysis, an options play you're possibly considering, or macro economic stuff in terms of a discussion, leave it down below and I'll be sure to answer you. So take care, guys. Been a pleasure as usual. I love all of you. Be very, very cautious into the next days and weeks of trading. The goal is to protect our capital, because if we get some phenomenal dips, right? Phenomenal dips on Microsoft, Amazon, Google, stuff like that, that's what you want to keep your buying power for, because those will be generational entries. Now is not the time to be building some YOLO call options for further all-time high consolidation or continuation rather, right? Be very, very patient. And if those truly generational entry levels are unlocked, I will share them with everybody and we are going to make tons and tons of money. So stay focused, right? Stay focused, stay consistent, stay disciplined in your strategies. I'll see you tomorrow after the close. Take care and peace.